Hello again. This is the second video uh, following up from the previous video where I demonstrated how to build a merger arbitrage position at a key support level, establishing a controlled cost basis. And I thought it would be proper to start with a screenshot of where we left off. If you recall in the first video, we built a credit basis at $8.91 at this level here. I believe the market value at the time of the video was approximately a $7.50 credit. Immediately following that video, the market bounced around on noise, which is atypical of a market neutral spread. And then at the close of the calendar quarter, we see that the Justice Department approved the merger. And this was the expected event from a fundamental probability. And the point of this is that it had one previously armed their position, or at least a percentage of their position, to take a program trade. Then profit was taken. Obviously, on the backfill here, you could have put that back on, but now the position is up to a credit of about $3. When it hit 250, we took opportunity there for liquidating is practical. I mean, there's just not a lot of reward to risk left in the position. I think the only thing left is the FCC approval. But basically, that's how a merger arbitrage position is expected to go. And obviously, the idea here is to build a portfolio of positions such as this, whereby you're controlling your last in, first out cost basis. And we showed how we built that position in the previous video. So let's continue along the illustration here. I want to show you a chart. Now I created this chart on a site that I found. I have no affiliation with this website. It's called Impactopia. And I like the site in the sense that they offer a lot of tools and an excessive database on different ways of measuring relationships between stocks in the database. And I went ahead and took the liberty of creating for illustrative purposes, a pair chart between Chevron and ExxonMobil. Now, these two stocks have no fundamental intrinsic value relationship. What they do have is a industry correlation. There's no mystery on the correlation. They both are integrated oil companies. And the purpose here is to get this chart here. The purpose here is to demonstrate what we're talking about with respect to market neutral positions and program trading. There's a lot of noise in the stock market, and so if this is your position, and let's say this line up here is your intrinsic fair value target, or your par on, for example, on the XM merger arbitrage, this could be a par value. But as you're waiting for your position to mature to a given target level, the idea is to program trade around your core position for at least a percentage of it. There's no reason to hold 100% of your market neutral position 100% of the time. The idea being that when you get a short-term dislocation, the program trading will take advantage of that, sell out a percentage, buy back, sell out another percentage, buy back, sell out percentage, buy back, and continue the process of what some traders call production or scalping around a core position. Of course, the idea here is that you are going to maintain a portfolio of these positions and set up a program trading model to exploit the market noise. Let's look at what a typical API would look like. This particular API, the program buy sell is a combination order. Basically, a standard template looks like this, where you have a contract ID or the security that you're going to have in a particular leg, what the ratio or quantity of that leg is, and whether that leg is if you're going to open it as a long or a short, and it's identified by a buy or a sell. This particular template asks for the exchange, and again whether that leg is an open or closing of the position. I'm not going to fill it out now, but that's what a standard template looks like. And this is your API for a program trade. Basically, you have, in this example, 2 legs to the program. It's 100 on the buy and 100 on the sell. This is a typical 1-for-1. As you recall, in the XM satellite radio Cirrus merger arbitrage, we had a 5 for 23. So you're going to set up your legs in an arbitrage, or in order to arbitrage in the proper ratio that you need to just set that up. So it doesn't necessarily have to be 1-to-1. It's going to be whatever your arbitrage dictates. And if you get these armed before the bell, there's a lot of realized gains that one can scalp. It might look like, take a look at some examples here. Okay, basically on a programmed market neutral pair, if you're going to, this particular model again exploits what some would call relative mean reversion. And in that type of a model, you're going 90% of the time you have a winning leg and a losing leg, profits and losses equally distributed, 50-50. The key difference, obviously, is the size of the profit and the size of the loss. I mean, this particular position was closed out, but you can tell that the winning side is almost twice as large as the losing side. The second thing I want to comment about quickly here is that, these typical programs with the broker, they default to first in, first out cost basis. It's really up to the trader to maintain a separate spreadsheet for last in, first out, so that you know where you are. Don't be surprised if the cost basis shows you a first in, first out. The way a trader knows where he or she is relative to maintaining a proper profit in the core position is last in, first out. And finally, I want to comment that Three's Company when it comes to arbitrage and market neutral positions. You don't have to have just 2 legs representing a particular position. For example, here this leg shared an offsetting leg with another particular leg. So there's lots of different combinations. It's just left up to one's creativity and resourcefulness. But that's the gist of it. Thanks again for viewing, and enjoy the markets.